Hello everyone, this is Ronan Blue, and for those that don't know me, this channel is all about how my girlfriend and I just started our financially independent debt-free journey since paying off our mortgage. With my newfound freedom, I talk about how we made it happen, the forms of passive income we have, our thoughts of early retirement overseas, personal thoughts, and general financial issues. Today's topic is on dividends, the compound king, part 1. Stay till the end of the video to learn how this long-term strategy will bring you to financial independence. Just as a disclaimer, the information provided is a general guide and to be used for educational purposes only. Dividend stocks have been a great stream of income for us for that regular income. Not only does it offer a chance to create that stream of income, it also adds a growth in your portfolio's market value from asset appreciation as well. That dividend is money that a company pays at set times to its shareholders. It's kind of like them saying, hey, thanks for investing in us, here's a little cash bonus. Most dividend stocks have that quarterly payment and increase their payments over time as well, and those dividends are basically the redistribution of assets or profits by a company to their shareholders. But here are a few ways to invest into dividends. One way would be by investing in dividend ETFs that offer a simple solution in getting exposure to a specific investment that pays a regular dividend. The dividend ETF has dozens, sometimes hundreds of dividend-paying stocks that give you diversification, adding safety for your payouts. There may be cases where some companies cut their dividends, but the effect will be minimal on the fund's overall dividend. If you want to invest in safety, this may be your top choice in buying any dividend-paying investment. But you want to make sure that the ETF is invested in stocks, also called equities, and not in bonds. You also want to look at the dividend yield as well. This is how much a company pays out in dividends each year relative to its share price, and it's usually in the form of a percentage. Most like the higher the better, although anything above 3.5% should be looked into closely before making that decision. Once you decide on that ETF through your online broker, a good approach would be to buy them routinely to take advantage of the dollar cost averaging. Check out my previous video on the topic. Another advantage of having one ETF would be that you don't have to track dozens of companies, which is what you'd need to have to do if you buy dividend stocks yourself. Finding individual dividend stocks, on the other hand, does take more work than selecting a dividend ETF. Because you'll need to analyze the company and industry, evaluate the safety of the dividend, then determine how much to buy. And since an individual stock is riskier than a diversified dividend ETF, you'll want to buy a portfolio of dividend stocks, not just one stock. Your portfolio should be diversified across most, if not all, the 5 main economic sectors. And the best time to buy dividend-paying stocks would be pretty much any time. You'll be able to find investments that are in position to survive periods of adversity. When you're about to find your investments, you want to have some with some of these qualities. Growth in income. The best dividend-paying stocks offer both capital gains growth potential and regular income from dividend payments. If the company currently offers a healthy dividend, this is a good sign of its potential to continue offering a steady dividend. It's a leader in the industry and has a strong hold on the growing market and has a unique product or service that cuts its competition. It has a history of long-term success. They will continue to keep paying and increasing their dividends. There needs to be a healthy financial situation for the company as well. You have to see whether the company is doing well, has done so consistently, and shows signs of growth, and will keep paying that dividend. Looking at the safety of the dividend is important as well. You'll always need to see what the payout ratio would be. This would be the percentage of income a company could pay out in dividends. They say that the lower it is, the safer the dividend, and the faster the dividend can grow over time. A red flag would be a payout ratio generally over 80%, but in some industries you don't want it even above 50%. You also have to decide on how much stock you want to buy as well. Diversification is key in buying those individual stocks, so we have 22 companies in our portfolio, and we try to keep it at about 5% of our portfolio in each. You want to usually place your money in more safer dividend choices than the more riskier dividend payout companies. Just think about the potential future growth of these lower paying dividend companies and not just the immediate growth you'll get from higher yields. If you're focused only on the higher yields, there is a high risk that the company won't be able to sustain it. Many investors view high yields as a positive sign, but for struggling companies, this commonly held perception can be destructive. The dividend yield is a function of the stock price, so as the stock price falls, the yield rises. So if the stock price falls due to poor performance, the yield will rise. The company, to stop the price from falling and causing further damage, holds the yield at a higher percentage and continues to pay that higher dividend. But by doing so, it means they spend less on debt reduction, capital restructuring, or other areas that improve competitiveness. So in the end, this plan backfires as the company runs out of money, which could have been saved if they lowered the dividend. You want to look for companies that have a stable income and cash flow. The more stable the money coming in to cover the dividend, the higher payout ratio can be without causing too much worry. The number one in consideration in buying a dividend stock is that safety of its dividend. If the divvy also happens to be cut, not only will you lose the dividends, but the stock itself will go down as well, so you'll lose twice on the investment. So this is why it is so important to choose wisely, not just for the yield. Dividend cuts will always undermine investor confidence and could quickly push down the company's stock price. Well, this is the end of part 1. Check out my next video in continuation to this one on dividends. If you like this video, please don't forget to give me a like, subscribe if you haven't already, hit that notification bell for more of my content here. Thank you for watching my vlog. I hope you have a great day and see you soon.